Welcome back to the deep dive. Today we are really getting into the engine room of global business.
Yep.
If you've ever looked at one of these massive multinational companies, think like a DuPont or Shell, maybe Cargill,
Mhm.
and wonder how on earth they coordinate everything, finance, inventory, HR, production, all across, dozens of countries.
Yeah.
How does it not just descend into total chaos? Well, the answer, really, it lies in this critical piece of technology. Enterprise Resource Planning, or ERP.
That's absolutely right. And our mission today really is to go deep on that. We're going to look at the essential nervous system, if you will, of what we're calling the modular enterprise. We've got a whole stack of sources here looking at ERP systems, and specifically these components called modules. They really are the blueprint for how these huge, complex organizations structure their work. It's probably the fastest way to understand how a big company is put together, anatomically speaking.
Okay, right. So let's unpack that core concept first. ERP.
Huh.
The fundamental definition.
Yeah.
It's essentially one single integrated software system,
Yeah.
right? Designed to manage all the core business processes. But the thing that makes it work for these huge global businesses, it isn't just the software itself, it's the architecture. It's these things called modules.
Exactly, a module. Well, the best way to think about it is as a logical grouping of related business functions. It's
Yeah.
sort of self-contained in a way. The sources use this analogy. Think of them like specialized departments in a huge company. You've got your finance department, your shipping folks, HR. Each one is focused on its specific job, right? But crucially, they are all perfectly connected back to one central hub. In this case, it's one central database.
And that focus is really important, isn't it? You might have, say, a financial management module, one for materials management, another for human capital management. Each one has its own specific workflows, its own tools just for those functions. But the magic, and this is where the enterprise part of ERP really kicks in, it's that integration you mentioned.
Uh-huh. That's the defining feature of a really good ERP system, like SAP, for instance. These modules, which seem separate, they're actually fully integrated. They share data across the whole organization in real time. They all read from and write to the same single unified database. And that structure, it just gets rid of all those manual handoffs between departments. So if inventory levels change because someone posted a sale, that info is instantly there for the accounting team doing the quarterly close. It's like this shared source of truth. It prevents errors, and it's that shortcut, really, to knowing what's happening across the entire business all at once.
Okay, so let's lay the foundation here. Why this modular structure? Why did the people who design these systems go this route? Why not just build one massive application that does everything? The sources seem to highlight a few key benefits, mostly around like structural clarity and how companies are actually set up.
Yeah, the modular design is pretty clever, mainly because it mirrors how companies are already structured naturally. Organizations think in terms of finance, supply chain, people. So structuring the software that way, it just makes sense. It simplifies implementation, it simplifies adoption. You're basically just digitizing the functional boundaries that already exist.
And that structure, it also allows for scalability, right?
Yeah.
Which must be huge when you're first putting these systems in. It addresses that initial shock. A company doesn't have to buy and turn on every single module from day one.
Exactly. They can start with the absolute core stuff, maybe finance is the most critical, and then later they can add on warehouse management or production planning as the business grows or as things get more complex. You activate only what you need right now. You can grow into the rest.
That seems like a much more measured approach.
It's vital, yeah. It makes the whole process, implementation, customization, user training just so much easier because you can focus your efforts on one specific business area at a time instead of trying to retrain the entire global workforce on like 12 new things all at once. And it's really the only way to get that true end-to-end process integration. Like seeing a new hire record in HR automatically kicking off a request for IT to get equipment ready and for finance to set up payroll, it just flows.
Let's get a bit more granular then. What actually happens inside one of these modules? It sounds like it's more than just a place to store data. It's like a workspace.
Oh, absolutely. Every module is built to support the entire end-to-end process for its specific area. Take materials management, MM. It supports the whole procure-to-pay cycle. From realizing you need something right through to paying the vendor's invoice for it, the module has all the tools you need. Screens for data entry, automation for the repetitive bits, analysis functions, reporting tools. It really is the digital factory floor for that specific business function.
Okay, and this brings us to something you hear about constantly with ERP, master data. It sounds critical, like the lifeblood of the system. What exactly is it, and why is getting it right So incredibly important.
Master data, yeah, it's fundamental. It's the core, relatively static information that defines how the business actually operates. We're talking about things like your customer list, vendor addresses, the specific details of your product materials, or, say, the tax codes you use in different countries. It's basically the set of rules that governs every single transaction that happens in the system.
So if transactional data is the day-to-day flow, the sale, the shipment, the payment, then master data is like the riverbed that shapes where the river flows.
That's a perfect analogy, yeah. And that's precisely why bad master data, or dirty master data as it's often called, is so incredibly damaging. If your master data, say, wrongly defines a product as taxable in Germany when it shouldn't be, well, every single sale of that product in Germany from that point on will be wrong. It'll require costly manual fixes, or even worse, you could end up non-compliant with regulations. Bad master data doesn't just mess up one report, it fundamentally breaks that integration chain across multiple modules all at the same time.
Wow. Okay. And we also need to remember that these modules control who sees what, right? Role-specific access. That seems like a big deal for governance.
Huge, absolutely. My HR team, they need to see confidential employee records in the HCM module. That's their job. But the manager on the shop floor, they only need to see their specific work orders in the production planning module, nothing else. The system makes sure users only see the data and the functions they need to do their actual job, which is key for security, obviously, but also just for efficiency. Keeps things clean.
And controlling that access, that requires careful management. Which brings us to who actually owns these modules. It's not just an IT thing, is it? The sources emphasize it's a business collaboration.
Definitely not just IT. Effective ERP relies heavily on business collaboration. The ownership roles are critical. And the sources are pretty clear. The real power, the ultimate ownership, lies with the business function itself. Each module is typically owned by a business leader. So the CFO owns the finance module, the head of supply chain owns materials management, and so on. These are the process owners. They're the ones who decide how the module gets configured and how it's used to actually execute the business strategy. The system has to support their defined process, not force them into a different one.
Okay, so the business defines the what and how. Who supports them day to day?
Right, supporting the process owner, you have the power users, and the business analysts. These are the people who really live and breathe the module every day. They handle the ongoing user training, they create the complex reports the business needs, and they're constantly looking for ways to improve the processes within their specific area.
And then finally, you have the IT team, the technology partner.
Yep, the necessary tech partner. The IT team. Their role is often misunderstood, though. They are not the process owners. Their job is the technical stuff. The configuration, making sure the system is secure, managing user roles and authorizations based on what the business dictates, handling updates and patches. It's a partnership that absolutely has to work. The business dictates the process, IT makes sure the technology foundation is solid, secure, and ideally pretty much invisible to the end user just trying to do their job.
Okay, that lays a really good foundation. We understand the structure, the why behind modules. Now let's get into the engine itself. Let's look at some of the key modules. Maybe we can group them logically. The sources mention financials, logistics, people, to see how that data actually flows.
That's a good way to approach it. These core systems, and we're talking things like financial management, FI, controlling CO, materials management, sales and distribution, SD, and production planning, PP, these really support almost every universal function that a complex company needs, pretty much regardless of their industry.
Right. Let's start where everyone feels it most. The money flow.
Okay, financials.
So there are two really crucial interlinked modules here. Let's start with the absolute foundation. Financial management, FI.
Right, FI. FI is all about external accounting. Its core function is managing the financial accounting side to ensure two main things. One, accurate financial statements for reporting, and two, absolute regulatory compliance. This is the module that gives banks, investors, regulators confidence in the numbers.
So when we talk key processes here, we're talking the nitty-gritty of statutory reporting, like general ledger posting, accounts payable, accounts receivable, tracking asset depreciation, calculating taxes, and that really intense period-end financial closing process.
Exactly. If you're preparing that quarterly report for the stock market or filing your taxes, the official, legally verifiable data originates in FI. And this is a good place to bring up some key master data again. The chart of accounts. That's the absolute foundation here. For anyone not in finance, think of it like the financial DNA for the entire company. It defines the universal language, the categories for every single monetary transaction, doesn't matter where in the world it happens. If a company operates in 50 countries, they all have to map their local activities back to this single group-level chart of accounts in FI. That's how you get true consolidation.
Okay, makes sense.
Right.
And the main users are the accountants, the auditors, the CFO's office, people focused on accuracy and compliance. But FI really only tells you what you spent, right? It doesn't tell you how well you spent it or where. That seems like a gap.
It is for internal management anyway, and that's where its counterpart comes in. Moving inside the business, we have SAP controlling, CO. This is where you see some interesting organizational tensions sometimes. FI has to provide the strict statutory external truth. CO, on the other hand, is designed to support internal cost tracking and performance analysis. It's all about helping managers make better decisions.
So FI is the strict rule-bound accountant, and CO is more like the proactive business manager trying to figure things out.
Precisely. CO gives managers the reports they actually need to run the business day to day. Its job is to answer questions like, okay, where did we actually spend that money? Down to the specific product line or department. And was that activity actually profitable?
Mm-hmm.
So key processes here are things like complex cost allocation, figuring out how to split the cost of shared resources like rent or IT across different departments or products. It also handles internal orders for tracking specific project costs and things like profitability analysis, COPA, which is really powerful. It breaks down revenue and costs by different dimensions, by product, by customer, by sales region, whatever makes sense for the business.
Okay. So FI might say, company-wide, we made a $100 million profit. But CO could tell you, yeah, but we actually lost money on product line B over in region 4, which is obviously vital for steering the business.
Exactly right. And the master data here reflects that internal focus. Things like cost centers, profit centers, internal orders. This module is absolutely essential for controllers, cost accountants, and operational managers. They need that flexible view of costs, and sometimes they need to look at things in a way that ignores these strict external accounting rules of FI just to get better insight for managing the business.
Okay, that covers the money flow with FI and CO. Now let's look at the next logical group, the physical movement of goods, the logistics and supply chain side. Maybe we trace the typical order of events, starting from when a customer actually places an order. That would be SAP Sales and Distribution, SD, right?
Correct. SD manages the entire order-to-cash cycle. It starts right from the initial customer inquiry or quote, and it governs everything that happens afterwards, creating the sales order, calculating the pricing, handling the delivery processing, and finally generating the invoice. Its core function is really managing revenues and sales, but also making sure customer service is timely and that the physical process happening lines up correctly with the financial postings in FI and CO.
And this module sounds incredibly powerful, especially around pricing. It must handle all those complex discounts, surcharges, taxes, and presumably it needs to check if the goods are actually available before confirming the sale.
Absolutely. It determines the final price based on potentially very complex pricing conditions. And yes, a key integration point is checking inventory availability, usually talking to the module before confirming the order. The key master data here would be the customer master record with all their details and history, and the material master describing the product being sold. The heavy users are typically sales reps, customer service teams, and this is where that integration really starts to visibly kick in. The sales order created in SD becomes the primary trigger for almost everything else down the supply chain.
Okay, so SD takes the order, knows what to sell. Now the system needs to figure out, well, do we have it? And if not, how do we get it? Which leads us straight into SAP Materials Management.
Right. oversees all the procurement activities and manages inventory. It's the module focused on optimizing the supply chain through, smart purchasing strategies, tight inventory control, and tracking the physical movement of all materials, raw materials, components, finished goods, everything.
And handles that whole procure-to-pay process we mentioned earlier.
Yes, the entire thing. It starts internally with someone creating a purchase requisition, basically, or request to buy something. That gets converted into a formal purchase order sent to an approved vendor. Then, when the materials physically arrive at the warehouse or factory, handles the goods receipt process, confirming what arrived, how much, and its condition. And finally, before finance actually pays the bill, manages the invoice verification step, matching the vendor's invoice against the purchase order and the goods receipt to make sure everything lines up.
That sounds critical for financial control.
It is. And the material master data is central here again, defining everything about an item size, weight, where it's stored, how much it costs. Also tracks vendor performance, purchasing contracts, things like that. And crucially, when those goods are received in the system automatically, instantly updates the inventory value on the balance sheet in FI. That real-time link ensures the company's financial position is always accurate.
Okay, so SD sold it, is managing the inventory and buying what's needed. If we're a company that makes things, knowing what materials we have or are getting, must feed directly into SAP production planning.
PP? Yeah, PP is essentially the brain of the factory floor. Its job is to coordinate all the manufacturing processes. It helps the business balance supply what we can make with actual demand coming from sales forecasts or orders. It basically tells the shop floor what needs to be built, when it needs to be built by, and what resources, machines, people, materials are required to do it.
So the key processes here are things like material requirements planning, MRP, which sounds like it calculates exactly what raw materials and components are needed based on the production schedule.
Precisely. MRP explodes the demand for finished goods down into the required components, taking lead times into account. PP also manages the creation of detailed work orders for the shop floor, handles capacity planning to make sure machines and work centers aren't overloaded, and provides tools for shop floor control to track the progress of orders as they're being made.
And the master data in PP sounds pretty technical. You mentioned bills of materials, BMs, and routings.
Very technical, yeah. A BM is basically the recipe for a product. It lists every single component, screw, wire, subassembly needed to make one unit of the finished good. A routing defines the exact sequence of operations, the specific work centers or machines involved, and the time required for each step to transform those raw materials into the final product. Getting the BOMs and routings right is absolutely critical for accurate costing and scheduling.
Okay, so the flow is SD gets the order, which might trigger to get materials, which feeds into PP to schedule the build. Once PP is done, and has maybe received the finished goods back from production, we need to store them efficiently, right? That takes us to SAP Warehouse Management, WM.
Exactly. WM comes into play to direct and optimize everything happening inside the four walls of the warehouse. Its goal is to ensure inventory is accurate, knowing exactly where everything is, and that orders can be fulfilled quickly and efficiently. It brings, granular control, real-time visibility, right down to the specific shelf or bin location.
So this is managing the actual physical movement within the warehouse, like figuring out the best place for put away when new stock arrives, optimizing the picking routes for warehouse staff, fulfilling orders, managing packing stations, doing physical inventory counts.
All of that, yes. It manages the physical choreography. The master data here literally maps the physical layout of the warehouse, the storage bins, the aisles, the zones, maybe specific handling units like pallets or containers. WM uses this map to direct movement efficiently.
Right, that makes sense. We've covered money and goods. What about the people side?
That brings us to the final core piece, SAP Human Capital Management, HCM, which many people probably still know just as HR.
Okay, HCM. So this supports the whole employee life cycle, from hiring to retiring.
Pretty much. Workforce administration, organizational structure planning, handling payroll, which is huge, managing benefits, tracking training and development. It's really about managing the people, the processes around them, and their potential within the company. And of course, ensuring all the legal and regulatory compliance stuff related to employees is handled correctly.
So processes cover hiring, firing, transfers, managing the org chart, time tracking, and that massive payroll process. That must integrate super tightly with finance, right?
Absolutely critical integration between HCM payroll and FICO. Payroll expenses need to post correctly to the general ledger in FI and potentially allocate costs to different cost centers in CO. The core master data here is the employee master record. This should be the single, definitive, verified source of truth for all data about every employee across the entire global company. It feeds information everywhere, cost centers in CO, salary expenses in FI, user access in various modules.
Okay, that covers the big core modules, the transactional heart of the business. But there are the other pieces, right? Tools to analyze all this data, or specialized systems for specific tasks.
Definitely. Once you have this integrated core, you start looking at extensions and supporting modules. A really important one is about making sense of all the data you're collecting. SAP, Business Intelligence, BI, or Business Warehouse, BW.
Ah, the analytics piece. So BIBW takes data from all those core modules.
And often from non-SAP systems, too.
Right, and consolidates it for analysis, turning raw transactions into actual business insight for making strategic decisions.
That's exactly its function. It's where the complex work of ETL happens, extracting data from the source systems like FI, CO, SD, transforming it by cleaning, standardizing, and maybe adding calculations, and then loading it into a separate optimized database designed specifically for reporting and analysis. This way, executives and analysts can run complex reports, build interactive dashboards, track key performance indicators, KPIs, without putting a heavy load on the core transactional systems that need to run fast for daily operations.
Makes sense to separate the heavy analysis.
Yeah.
Okay, what about companies that run big projects, like construction or R&D or maybe large consulting engagements?
For that kind of work, there's SAP Project System, PS. PS is designed specifically for managing complex, unique, non-repetitive projects. It integrates the budgeting, scheduling, resource planning, and tracking of execution across different modules. Its whole focus is driving project success by providing structure and really deep tracking capabilities for both costs and timelines.
And the key data structure here, the sources mentioned work breakdown structures, WBS. Sounds like a detailed task list for the project.
Essentially, yes. The WBS breaks the entire project down into smaller, manageable chunks or tasks. And crucially, PS links these WBS elements directly to things like cost centers back in CO and budget line items in FI. This gives the finance team and project managers full visibility in real time of how costs are accumulating against the project budget. It's vital for keeping large projects on track financially.
Okay. Now, you mentioned something earlier, the invisible engine, SAP Basis. This sounds purely technical, but important.
Utterly crucial, but yes, purely technical. Basis is the underlying technical foundation. Think of it like the operating system and database administration layer for the entire SAT landscape. Its function is simply to make sure the whole system runs securely, performs well, and is available when people need it, ideally 24/7. It really is the invisible engine keeping the whole thing running smoothly and safely.
So the Basis team are the sysadmins of the SAP world.
Pretty much. Basis administrators handle installing the system, configuring the servers, tuning performance, managing backups and restores, and critically, they handle all the user administration and security profiles. When we talked about role-based access earlier, making sure a user can only see certain project data in PS or specific customer info in SD, it's the Basis team that technically defines and enforces those security roles based on the rules set by the business and IT security policies.
Got it. Okay, last couple of extensions. What about managing relationships externally, customers and suppliers? We have SAP Customer Relationship Management, CRM.
Right. CRM is focused outwards on the customer journey. It supports the sales teams, marketing, customer service functions. It's about building and maintaining those customer relationships, managing sales leads and opportunities, running marketing campaigns, handling customer service tickets and requests. The goal is always to boost customer satisfaction and ultimately drive more revenue.
And the flip side of that, looking at the supply base, is SAP Supplier Relationship Management, SR.
Exactly, the mirror image. SRM focuses on streamlining everything related to the company's external suppliers. That includes selecting suppliers, strategic procurement planning, managing contracts. It helps manage those critical supplier relationships through processes like qualifying new suppliers, running online bidding events, e-sourcing, and managing the entire contract lifecycle. And interestingly, these two, CRM and SRM, are often areas where companies face that strategic decision. Do we use the integrated SAP module, or do we go with a specialized, best-of-breed external system? Which leads us nicely into the strategy section.
Perfect transition. We've got the structure of the modules. Now let's really dig into the high-stakes decisions the strategic trade-offs companies face when they implement and manage these massive systems. This is the so what. For listeners' understanding, the tough choices behind achieving that enterprise integration dream.
And the absolute starting point for any strategy discussion has to be the main selling point, the reason companies spend millions on these systems, the unparalleled power of that integration.
Right, because all the modules use that single shared database. When a transaction happens, it's not just copied around. It's written once, and that single version of the truth becomes instantly available and valid across every single relevant module.
Let's use that DuPont example from the sources to really illustrate the seamless flow. Imagine a customer service rep sitting in the SD module creates a new sales order. That single click, that one action, doesn't require them to then call inventory, email finance, etc. Because it's integrated, that single transaction automatically triggers several logical steps simultaneously. 1. Inventory. The system immediately checks and reserves the available stock for that order. The quantity available for other orders instantly drops. 2. Manufacturing PP. If reserving that stock causes the inventory level to fall below a predefined safety threshold, the system can automatically generate a demand signal in production planning, telling them they might need to make more soon. 3. Finance, FICO. The system instantly creates the necessary accounts receivable entry in FI. It posts the expected revenue, maybe provisionally, and it updates the profitability analysis data in CO related to that customer or product.
Wow. So it's instantaneous, and because it's the system doing it, it's error-free, at least from a transcription perspective. No human rekeying data between departments.
Exactly. It eliminates those human errors, it gets rid of information delays, and it means when the CFO pulls up a report on current inventory levels, it's literally accurate up to the last transaction posted seconds ago. That speed and accuracy, it just dramatically improves the quality of decision-making at all levels.
Okay, that's the ideal, that's the goal.
Okay.
But getting there involves navigating the often tricky commercial side, the pricing of these modules. They're notoriously expensive, aren't they?
Extremely expensive. And the procurement strategy often bumps up against the temptation of big discounts if you buy more upfront. The contract price for an ERP system, it varies hugely based on which modules you buy, how many users need access, sometimes even the volume of transactions expected. Naturally, companies often want to phase their purchases, buy what they need now, but the vendors, understandably, often offer pretty hefty incentives, big discounts, if you buy a larger bundle of modules right at the start.
Which leads to that Cargill anecdote mentioned in the sources. That sounds like a cautionary tale.
It really is. During a big implementation push, Cargill apparently got offered massive discounts on certain modules they thought they might need, 5 or even 10 years down the road. It looked like a great deal at the time, so they bought the bundle. But years later, the story goes, many of those future need modules were still sitting there completely unused, never implemented, never turned on, and the takeaway is really profound. Unused software, even if you bought it cheap, still costs way more than zero. There are ongoing maintenance fees, the initial purchase cost, maybe even the server space and IT effort to keep it patched, even if it's dormant. The point is, strategic buying has to align with your actual current implementation roadmap, not just some vague hypothetical future need based on a discount. Resist the deal if it doesn't fit the plan.
That caution around cost and buying only what you need often leads companies to another big dilemma, the best-of-breed problem. What happens when the integrated SAP module for a specific function just isn't as good as a specialized external tool? Do you sacrifice that seamless integration for better functionality?
The classic management trade-off. It happens a lot. Sometimes a dedicated external system, what the industry calls a best-of-breed solution, genuinely offers a better user experience or maybe more niche cutting-edge features than the equivalent module within the big ERP suite. The example given is Dana Corporation. They apparently made a conscious decision to keep their existing Salesforce CRM system rather than ripping it out and implementing SAP's CRM module.
Okay, but hang on. Given everything we just said about the power of integration, why would they do that? That seems counterintuitive.
Well, the rationale was likely twofold. One, Salesforce might have offered better, more tailored functionality specifically for their sales processes at that time. Two, and this is huge, their entire sales team was already fully trained, familiar, and highly productive using Salesforce. So the functional gain of sticking with the known superior tool was immediate. And they avoided a very expensive, potentially very disruptive project to implement SAP CRM, which might have been seen as less mature or less suitable for them at that point.
Okay, I see the appeal, but let's play devil's advocate. Integration is king, right? So isn't that a net loss in the long run? You've now got two critical system sales and the core ERP that don't automatically talk to each other. What are the hidden costs there?
Oh, the trade-offs are significant and the hidden costs can be substantial. While Dana gained that immediate functionality and user satisfaction, they absolutely sacrificed the seamless integration. The biggest hidden cost is the need to build, and more importantly, maintain complex custom interfaces middleware to shuttle data back and forth. You need to make sure that when a deal is closed in Salesforce, that information flows accurately and reliably into SAP's finance, FI, and materials management modules to trigger invoicing and fulfillment. This adds technical complexity. It often introduces reporting lags because data isn't truly real-time across both systems, and it requires dedicated internal IT resources just to monitor, patch, and update those interfaces every single time either Salesforce or SAP releases an update or changes its APIs.
Right, so you're paying the external subscription fees for Salesforce, plus you're paying your internal IT team to constantly maintain the digital plumbing between the two systems. It sounds like maybe a temporary fix.
Often it is. It's a pragmatic choice for the short term. The long-term goal for most companies in that situation is usually eventual full integration within the ERP suite, but they might wait until the ERP module catches up in terms of features, or until the pain of maintaining the interfaces becomes too high. But sometimes that functional gap is just too big to ignore right now.
Okay, moving from what software to buy to how you actually roll it out.
Hmm.
Companies face another huge strategic fork in the road, the implementation strategy.
Yeah.
Basically, phased versus big bang.
Right. The phased approach is generally seen as lower risk. It's pretty common when a company is moving off a real mix of old, disparate legacy systems. They start smaller, maybe they implement just the core finance FI module first, get that stable, get the finance team comfortable. Then, in a later phase, they add related submodules like accounts payable, maybe link it up with materials management.
The Nortel Networks example fits here, right? They started with financials first.
Exactly. Nortel apparently rolled out FI, let the accounting function stabilize on the new system, and only then did they bring in sales and distribution, SD, followed later by materials management, and so on. By reducing the scope of each phase, they made the rollout more manageable. It limited the sheer amount of change hitting the organization at once, and critically, it lowered the risk of catastrophic failure disrupting the entire business.
But there must be a downside to phasing it. It sounds slower.
It is slower, and the main downside is short-term complexity. While Nortel's new FI system was live, they had to build and maintain temporary, often expensive and clunky interfaces between the new SAP FI module and all the old legacy systems that were still running the sales, inventory, etc., functions that hadn't migrated yet. So you trade off immediate full integration benefits for lower risk. It's a slower path, but it fundamentally caps the potential downside if things go wrong.
Okay, so the opposite approach is the Big Bang implementation. This sounds dramatic. All modules go live everywhere, all at once.
Pretty much, often literally overnight or over a weekend, globally. Cut off the old systems Friday. Everyone comes in Monday using the new, fully integrated SAP system. It's a high-impact approach and inherently a very high-risk strategy.
What's the benefit? Why take that risk?
The main benefit is you achieve standardization and realize those powerful integration benefits across the entire organization from day one. No temporary interfaces needed. Everyone is on the same system immediately. The massive downside, though, is that so much changes at the same time, more people affected, more processes changing, more data being converted. The potential points of failure multiply exponentially. If something goes significantly wrong during a big bang go live, it can be incredibly disruptive, even paralyzing to the business.
The sources mention Bay Networks pulled off a successful Big Bang. But the pressure must have been immense. You usually hear more about the Big Bang failures, the ones that cause chaos or huge financial write-offs.
Exactly. A big bang failure can be an existential threat. So the choice between phased and big bang, it's less about the technology itself and much more a reflection of the organization's appetite for risk, its readiness for massive change, and critically, its capability in managing that change effectively across the entire company.
Okay, another internal conflict point. Customization versus standard functionality. The ERP vendors always push using the standard out-of-the-box solution, right?
They do, and for good reason. Standard ERP modules, like SAP's, are designed based on best practices gathered from thousands of companies worldwide. They probably cover 80%, maybe 90% of common business processes quite well. The easiest, cheapest, and most maintainable path is always to adopt that standard functionality and maybe adjust your business process slightly to fit the software.
But reality isn't always standard, is it? Sometimes a company has a truly unique business process that gives them a competitive edge. Or maybe there's an external factor, like a specific regulation, that the standard software just doesn't handle. You have to deviate.
Precisely. Sometimes customization isn't a choice, it's a necessity. This is where the Bristol-Myers Squibb, BMS, example is really insightful. BMS apparently used standard SAP Materials Management, for their general procurement processes, buying office supplies, basic raw materials, because that's pretty universal. But they heavily customized their SAP Quality Management, QM module. Why? Because as a major pharmaceutical company, they face incredibly strict, detailed, and often unique compliance regulations from the FDA, Food and Drug Administration, and other global health authorities. The standard QM module, as delivered, simply couldn't meet all those specific pharma requirements out of the box.
So their hands were essentially tied by external regulations. They had to customize QM to stay compliant and be able to sell their products, even though they probably knew it would add complexity later.
Exactly. They had to prioritize immediate compliance and operational necessity over long-term technical simplicity. And the cost is long-term maintainability. This point cannot be stressed enough. Custom reports, custom workflows, unique flight written specifically for BMS's process, often called Z code in the SIT world. Yes, it has immediate value. It gives them that perfect functional fit they need right now. However, every single one of those custom elements has to be meticulously reevaluated, retested, potentially debugged, and maybe even partially rewritten every single time SAP releases a major upgrade or even a significant patch to the standard QM module. That customization debt accumulates rapidly over time. It makes future upgrades much slower, more complex, and significantly more expensive. So that decision, do we customize for a perfect fit now, or do we stick to standard for easier maintenance later, is a fundamental strategic choice with long-lasting consequences.
Wow, that's a really important trade-off to understand. Okay, finally, let's briefly touch on how ERP systems handle really specialized markets. The core modules like FI, CO, MM are pretty universal, but some industries are just different.
That's right. While the core handles the basics needed by almost everyone, they don't capture the full operational reality of every single niche market. That's why SAP and other vendors offer industry-specific IS modules. You see things like IS Oil for oil and gas, IS Retail, IS Utilities, IS Healthcare, and so on. These modules contain functionality specifically designed for the unique, complex requirements of those industries that the core modules simply can't handle alone.
The Shell Corporation example in the sources seems to illustrate this perfectly. They use the core modules for corporate functions.
Exactly. Shell would use the standard core modules FI, CO, MM, HCM to manage their consistent group-wide corporate functions. Things like central financial accounting and consolidation, group budgeting, general corporate procurement like buying laptops or office furniture, HR policies.
But for their actual oil and gas operations, they need something more specialized.
Precisely. They would implement the specialized IS Oil module on top of the core. IS Oil contains functionalities specifically for managing their unique upstream and downstream operations. We're talking about things completely alien to most businesses. Managing the complex budgeting for oil exploration projects, tracking detailed production data from individual wells, handling the incredibly complex scheduling of crude oil tankers and pipelines, managing the transfer pricing of product moving between exploration, refining, and distribution. These processes are so unique to the oil and gas industry that trying to force fit them into standard production planning, PP, or materials management, MM, would be impossible or incredibly inefficient. The IS Oil module provides that necessary vertical industry depth while still integrating horizontally with the core FICO modules for overall financial reporting.
Okay, so it's like a two-layer system. The core modules ensure corporate consistency and standardized financial reporting across the whole group, while the industry-specific modules handle the unique operational complexity out in the field, the bits that actually make the money in that specific industry.
That's a great way to summarize it. Core for consistency, industry solutions for operational depth.
What an incredible journey. We've really dug into the structure of the modern complex enterprise today. It seems clear that these ERP modules, they're not just software features, they're the actual structural components that define, manage, and coordinate pretty much every significant business process on a global scale. They provide that essential structure, a surprising amount of flexibility in how you implement them, and most critically, that real-time integration that transforms how different departments have to work together.
Yeah, understanding the modular nature of a modern ERP system is, in a very real way, understanding the operational blueprint of a large corporation. Every module has its designated business owners, its defined processes, its critical master data that needs to be kept clean. But the real organizational power, the leverage, it comes from that single shared database underneath it all. That's what forces or maybe enables every function to work from the same immediate shared version of the truth.
So, as you, our listeners, move forward and encounter these systems in your own work, whether you're in HR, finance, supply chain, wherever, maybe keep this final provocative thought in mind. It's about that high-stakes balancing act that's required for real ERP success. Perhaps the single most defining long-term choice an organization makes when implementing or running an ERP is that decision we discussed. Do you customize a module to perfectly fit your unique process, like BMS had to do for critical FDA compliance? Or do you rigidly stick to the standard functionality, even if it means changing how you work?
That customization choice, it really is the fundamental trade-off, isn't it? It's a choice between achieving that immediate, perfect operational fit, getting the system to match your ideal process exactly, versus ensuring long-term, lower cost maintainability and easier upgrades down the road. Are you prepared to pay that ongoing customization tax forever to support that unique process? Or are you willing and able to adjust your established ways of working to align with the global standard embedded in the software? That question, probably more than any technical feature, really defines the long-term success and ultimately the true cost of running the modular enterprise.
We're a really powerful point to end on. That's the deep dive for today. We really hope you feel better equipped now to understand and navigate the world of ERP modules. We'll talk to you next time.